First of all, congratulations. Reaching 1 crore in corpus is a big deal, and you have probably spent the last 8 to 12 years building this corpus through SIPs, bonuses, salary hikes, maybe a bit of luck, but mostly discipline. And this is not a small milestone. Most people dream of this number by a certain age. You've lived it, you deserve it. And इसी बात पे मुंह मीठा करना तो बनता है. तो आपकी जगह मैं कर रहा हूँ भी, मेरा तो नहीं हुआ है, बट फिर भी on your behalf. But now comes the real question, what's next? Because here's the truth that very few people will tell you, especially on social media. Hitting the 1 CR number is not the finish line, it's the entry ticket. You're now in the phase where your compounding engine is finally kicking in. The next 1 crore won't take a decade, it might just be 3-4 years. And after that, it could be a snowball where 1 to 2 to 4 to 7 CR. This is the stage where growth can explode if you can protect it. And that's the key word, protect. At 1 CR, the biggest mistake you can make is chasing quick returns or over-optimizing for growth. Because when your capital base is large, even a small mistake, let's say a 15% drawdown, means wiping off 15 lakhs off from your portfolio. That's not just money, that's years of effort. So yes, do celebrate your 1 CR milestone, you've earned it. But now is when you need to be more thoughtful than ever about diversification, about risk, about what you're saying no to, because from here your wealth can grow exponentially or erode silently. The next chapter isn't about getting rich, it's about staying rich and staying smart. Now let me be clear, this video is not about giving you a strategy plan, an investment plan, or some fixed 10 crore roadmap, because investing is dynamic. What works today might not work 3 years from now. Markets evolve, tax laws change, asset classes go through cycles. So any fixed plan I give you could be irrelevant in the near future. But what doesn't change are certain mindset principles, the universal rules, and the common traps that investors generally fall into between their journey from 1 CR to 10 CR. And that is what this video is about. So in this video, we are going to talk about the loopholes, the blind spots, and the mental rewiring you'll need to reach 10 CR. Because more than your mutual funds or SIPs, this journey will be shaped by how you think. So let's get started. Number 1, surviving temptations of play money. One of the most dangerous phases in investors' life is not when they have nothing, it's when they have just enough. And we see this pattern especially among professionals in their 30s and 40s who accumulated around 1 CR or more. At this stage, many people make this very same mistake. They don't risk the entire 1 CR, they just experiment with a small part, maybe 10 lakhs, 20 lakhs, or maybe even 30-40 lakhs, thinking, this is my play money. If it works out, great. If not, it's fine because I've already made my peace with it. And that is exactly where the spiral begins. They enter the world of maybe futures and options, intraday trading, or leverage calls, areas that are incredibly complex, volatile, and designed for ultra professionals, not casual dabblers. They may get lucky once or twice. Maybe the 10 lakhs turned into 20 lakhs and the adrenaline hits. They believe I have figured it out and I can do this. But eventually the market humbles them. This is basically how markets draw you in, and when they lose, they say 15 lakh, it's not just about the money anymore. Now the brain basically goes into a recovery mode that I need to win this back at any cost. That is when it becomes an emotional addiction. Basically, it becomes like a video game where you have more lives, and that lives is basically coming out of the money that you have. Not to trading, but to a recovering loss. They start to take bigger bets, they double down, they deviate from the original plan, and within months, what started as a 10 lakh experiment becomes a 30-40 lakh dent in your portfolio. You've seen this play out in real life. There are actual real life examples for this. A former JP Morgan consultant recently shared a story of an investor who built up a 2 CR through hard work, through salary, but only to lose 1.4 CR in FNO trading within months. SEBI data clearly shows that Indian retail investors lost 1.05 lakh crores in derivatives trading in financial year 25. A staggering figure that points out to a mass participation in high-risk products by people who had no risk management frameworks. And mind you, some of these folks left their full-time jobs to pursue this. You must think that this may never happen to me, but remember, this is how markets draw you in. And here's the kicker. The spiral happens precisely when your compounding engine is kicking in. From 1 CR, the next crore is faster, and the next one even more so. If you lose your base, the journey resets. Don't justify the risk because it's a small part of your portfolio. At 1 CR plus, even a small mistakes can be equal to a multi-year setback. Don't trade because you're bored or curious or confident. Respect the money, respect the compounding, because the market doesn't care how long it took you to reach to your first CR. It can take it back in weeks. Just remember, this was the whole point. Now, point number 2, build cash flow, not just corpus. Now, there is a subtle but important shift that needs to happen after you cross your 2 to 3 CR. Till now, your mindset was grow the corpus, do the SIP every month and let the compounding work. And that works beautifully, especially from 1 CR to 2 CR to maybe even till your 3 CR. But once your wealth base grows, you need to move from only accumulation to partial monetization, not in the sense of spending, but in the sense of building some cash flow. Why? Because real life isn't a perfect spreadsheet. Life throws curveballs, layoffs, illnesses, sabbaticals, failed startups, market crashes, elder care responsibilities. And while your 3-4 CR corpus may look impressive on paper, if it doesn't generate a monthly income, you're still dependent on your job or for your withdrawals. Now instead, imagine this. You have invested 1 CR in a diversified mix of maybe REITs or target maturity debt funds or dividend yielding equity funds or some corporate bonds, and you're receiving a modest maybe 5 to 6% annual yield, which gives you 6 lakhs a year, which basically is 50,000 a month. Now that becomes your passive cash flow. Now basically you have, let's say, either a second income or a second salary. You don't need to touch your main investments. You can reinvest that 50k a month into more SIPs, gold or bonds, or keep it in liquid funds as buffer. And when the life hits you with a bad month, your portfolio sends you a check. You're not forced to break equity at a market bottom or redeem long-term assets prematurely. This is how true financial resilience is built. Not just by having a 5-year corpus, but by ensuring that the part of it pays you back regularly. This isn't about early retirement or flashy financial freedom dreams. It's just about good planning. Ask any second generation wealthy family, almost all of them prioritize stable and recurring income after a point of time, which basically includes their rentals, dividends, bond interest, some other business returns, etc. Because when markets go sideways for a year or two, it's not just the corpus that saves you, it's the cash flow. As you grow past the 2-3 CR mark, ask yourself, if I stopped working for 6 months today, does my portfolio send me a paycheck? If the answer is no, maybe it's time to rethink how your wealth is structured. Because the corpus looks good on paper, but cash flow feels really good in real life. Number 3, cardinal sin of sticking to just one asset class. Now imagine this, you're 40 years old, you've built a 1 CR corpus primarily through equity or mutual funds. You have done everything right, SIPs, asset allocation, market dips, you stayed calm through it all. Then for the next 3 years, the market starts falling, maybe due to global inflation, geopolitical shocks, or a recession in the US. Your 1 CR typically drops down to 72 lakhs. But it's not just paper loss anymore, because right now your daughter is in class 9 and maybe you need 15 lakhs for her college admission in 3 years, and you don't have that liquidity. All your money is in equities. You'll be forced to sell those mutual funds at a very heavy loss. Now imagine being forced to withdraw at a loss because you didn't diversify. You didn't have the short-term money in debt. You didn't keep a liquidity cushion in the place. You knew diversification mattered, but you didn't feel the cost until now. Or just flip the scenario. Let's say you're a real estate guy, you own 2 flats, you're confident, you get a phenomenal startup advisory opportunity, but you need to invest 25 lakhs very quickly. You don't have it. Your wealth is logged. You watch the deal pass by. You just lost a 10x opportunity, not because you didn't have wealth, but you didn't have the liquidity. Now that is exactly what lack of diversification does to you. It doesn't just reduce returns, it shuts down choices, it forces bad exits, it robs you of peace of mind. Diversification isn't just about market risk, it's about life risk as well. Your kids' education, your career pivot, a medical emergency, your dream home. Markets don't care when your life needs cash, but you should. So yes, you might have made 1 CR through mutual funds or real estate or crypto or fixed deposits, that's fine. Respect that. But don't get romantic about the road ahead. The road to 10 CR requires more maturity, and diversification is the maturity to admit you may not know which asset class will win next, and that is why you own more than one. Number 4, don't pause, accelerate. One of the most underrated superpowers on your journey to 10 CR is this: appreciating your savings rate. Not your income, not your mutual fund returns, but your savings rate. It is easy to track net worth, portfolio value on the latest XIRR or your SIPs, but what often goes unnoticed is whether your savings percentage is increasing along with your income. Let's say earlier you were saving about 40% of your 1 lakh monthly salary, that's about 40,000. Now your income grows to 2 lakhs, but most people still save about 40 to 60,000 and feel great about it. But their savings rate, if you see, has actually dropped. And here's the truth. If your income keeps on rising, but your savings rate stagnates, your timeline to 10 CR basically gets delayed. Now, this doesn't mean you don't enjoy your money. Yes, go buy that iPhone, take your family to Europe, upgrade to a bigger home if it brings you joy, do all of this, do all the materialistic things that you have all imagined of. But at the same time, upgrade your savings rate too. Think of it like this. The earlier in life you raise your savings rate, the less pressure you'll feel later to chase those risky returns. If you can push your savings rate from 40% to 50 to even 60% without feeling pinched, you're creating serious tailwinds in your portfolio. That extra 10 to 20% saved today has a huge compounding impact 10 to 15 years down the line. It's a privilege to increase your savings rate. Most people don't have the margin. If you do, don't waste it trying to match someone else's Instagram lifestyle, because here's the quiet math. 10 CR is not just about earning more or investing better. It's about preserving and amplifying the gap between what you make and what you spend. And the best way to do that is by every time your income goes up, ask yourself, can my savings rate go up too? If the answer is yes, you have just taken a giant step towards financial freedom without sacrificing the good life. So that's it, guys. This was not about giving you a wealth plan, but to give you that mindset that you would always need. So just save this video because you would want to see it when you reach your next CR, then your next CR, and your next CR again. So subscribe to the channel and keep following us for more such videos.